Welcome back. I hope you all had a wonderful lunch. My job is to help you wake up, get out of that food coma, get re-enthused for an afternoon of exciting panels. I hope you enjoyed this morning, and I hope you enjoy the rest of the day of learning and kind of networking with fellow people at this Wealth Summit. Some of the panels this afternoon, they're a bunch of exciting ones. I'm particularly excited actually about the idea of art as a haven investment. I should claim my own panel as the best, which is about the wealth transfer amongst generations in Asia. We'll also be looking at digital wealth and women in wealth as well. So one of my other jobs, apart from waking you up and pretending that we're all really focused again, is to get you aware of interacting with us. And that is that there is this QR code, which you can scan, this thing on the screen now behind me. And that's how you interact with questions. That's how you kind of get involved in the polls. And just to kind of show that now, if you can scan that, we are going to do a practice poll to make sure that people can work technology. I'm glad I'm talking rather than trying the technology bit, because I'd probably mess it up. So we're going to do a sample poll now, if we can get that up on the stage. Or maybe we want to give everyone another second to scan the QR code. Are we saying goodbye to the 60-40 portfolio? I'm hoping only one person has voted so far. Otherwise, the poll is broken. Or maybe you're all consensus. I don't know. Okay, 60-40 is still a good strategy. Okay, while we're waiting for more results to come in, I should tell you that if you aren't already a subscriber to Bloomberg.com, you can wander outside and get a free subscription if you want. It's the booth just outside the door, around the corner, before all the food. Don't get distracted by the dessert. Get your free subscription first. And then back to this poll. Okay, we're still agreed. We've got a few more voters now, but we are still agreed. We do need more new models. I'd agree with that too. I think that makes sense. Let me just check if I'm meant to tell you anything else. I don't think I really am, actually. I think we're about to get going, but, oh yeah, I am meant to tell you about, of course, social media, the bit that I always forget. So the one other slide I want to bring up is or how to engage with us on social media. It is hashtag BBG Wealth Asia. You can see it just there below, Wealth Asia Summit. Please get involved, please participate, please tag us. Thank you very much and enjoy your afternoon. Cheers.
Please welcome to the stage Nicole Denholder, founder Next Chapter Raise and co-founder Sophia.com, and Lena Wong, founder Hong Kong Momtrepreneurs and founder Woman Tours, for a conversation with Bloomberg's Fionn Lee.
Good afternoon. Welcome back from your lunch. Hope you all enjoyed it. I have two wonderful speakers today, Nicole and Nina. And we prepare for this panel. We always talk about Bloomberg loves data. So we want to start setting the stage, giving us context on the topic with some numbers and statistics. Shall we start with Nicole?
Okay, great. Hi, I'm Nicole Denholder, and really my big focus is on women and their money through both my businesses. So with a focus on entrepreneurs and fundraising, and then on financial literacy for women. So that's why I'm really interested in the data that we've got. So I'm going to just quickly walk through a couple of sets of data that we kind of look at to set the stage as to why it's such an important topic, but also such a great opportunity. I really want to emphasize we just look at this as an opportunity. So if we look at the female founders in terms of their fundraising success, so if you look at PitchBook data from 2022, only in the US, we'll start with the US, only 2% of fundraising goes to all female-led businesses. That drops down to 0.9 when you look across at Europe. If you go across to Australia, that's 3% coming out of their startup report. And if you move and look at mixed gender teams, you're around that 10% in Australia up to around 16.5% in the US. So you kind of got this aspect of women are not fundraising that much. There was a recent JP Morgan private bank report that shows that nearly 15,000 companies across 12 markets in APAC are identified as high growth, and only 848 companies, or 5.7%, are women-powered. So what we're seeing is that there's a real link between the fact that we need more funding going to women. We can then be seeing more women in those high-powered, the funding cycle. We want to get them into that funding cycle a lot more. And in that same report from JP Morgan, one positive has been seen an increase in the number of funding that goes to women. On average, a raise has gone from $10 million to over $40 million, particularly. So that's great news. We want to have some good news in this environment. If we just look at funding led by women, so actually fundraising in terms of VC space, just in the first quarter of this year, again, according to PitchBook, male-led funds have raised $11.7 billion, where women-led funds have raised $100 million. So it's a vast difference in terms of the money being raised by women to deploy. And in total for 2022, that was $170.8 billion by male-led funds versus, or all other funds, I should say, versus $2.4 billion led by women-led funds. So again, big gap there. And in Australia, only 1 in 3 venture capital firms have invested in a female-led business in the past year. And if we look specifically at Asia, there was a Deal Street Asia report that came out, and there are no female investment decision makers at 77% of venture capital firms across Southeast Asia. So we, again, don't have a lot of female representation there. But some good news in Asia is that we've seen the biggest increase in gender lens investment funds since 2017. So over 70% of GLI funds here in Asia have come up since 2017. So that's some good news. I just want to finish off before we move on, just looking at women and their personal money. Again, the world's 51% of women, but they only control 1/3 of the wealth. Women live longer, they hold more cash, they retire with less, unfortunately. So we're seeing a bit of a cycle that is repetitive. But according to Oliver Wyman, there was a report that showed that there's a $700 billion global revenue opportunity in better serving women as customers. So it's a great number to focus on. So that's why we look at those opportunities. And at our own company, Sophia, we did an informal survey recently across Hong Kong and Singapore. And 96% of our respondents want to improve their financial knowledge. So it's great. So there's an interest there from women in learning. 55% of respondents get their financial information from family or friends. So they're not really looking at externally for that. So there's an opportunity there. And 82% of women want to learn more about investing and wealth management. So just kind of setting the scene of the opportunities and the statistics there.
Wow, this is great. It's good to know there's some good news in those statistics that you talk about. Dina, anything to add?
Okay, so hi everyone, good afternoon. My focus will be more about recruitment, retentions, and returnship for women in our industry. So as we just, like what Nicole mentioned, 51% of the population is female. We actually see gender parity at the entry level in Hong Kong. So look at some statistic in 2021 in the financial service industry. We had about 432K female working in the industry. And for men, we have about 430,000. But if you look at the median salary, monthly salary of these two groups, you actually see quite a bit of gap. The median salary is 19,800 for female and is 24,000 for male. So we see a gap there. And even if we look at beyond just the entry level, you then see the numbers actually widen. At the entry level, it's 51, 52%. According to PwC report in 2021, the gap become wider. The female is only 29% of the management. So we wonder, like, what happened? Like, why we see less women as we progress further in the career path? One would assume it would be, gut feeling, unconscious bias. Other would see as possibilities of family obligations. But we might want to also see what sort of job functions these people engage in. And so I think we still largely being stereotyped that female, even if they have well-qualified educations, will be handling roles such as client-facing, compliance, or operation, where you can see the male are still dominating more the fintech, investment, or trading roles. So that's some of the observations that we see in the industry. And in terms of retaining the female talents in the industry, we actually see a report from the Equal Opportunity Commissions in 2018. So I hope they will do a newer one. A lot of women actually spot in the first 12 months after they return to work from maternity leave, 22% of them face discriminations during the pregnancy or maternity leave. And then 15% face discrimination against promotion. And about 35% indicated that they notice impolite behavior. And so we might have some good news. As we all know, since we have all the financial service practitioners here, that the Hong Kong Exchange has implemented and have the listed companies to have at least one female or opposite sex directors to be among the board of directors by the end of 2024. But recently, the American Chamber of Commerce Women of Influence actually ran a survey of 200 professionals, and interestingly, about 54% of the respondents indicate that this requirement will not result in gender diversity on the board. So from the sound of it, I hope I didn't finish with a very negative note, but there seems to be a lot we need to do.
Yeah, definitely. And let's go beyond the numbers. And how about we also want to focus on the solutions, and we lay out some of the issues that women face at workplace and in terms of wealth creation. And we should talk about life priorities at the same time. I know some women might not prioritize wealth creation or management at the top of their list. So how should we tackle that as financial planners or private wealth bankers? Any thoughts?
Sure. Yeah, we often talk about this, that in life things drop to the bottom of the list, and unfortunately things like budgeting, looking at your money, can for many women drop to the bottom because there's things that are inflexible in your life. There are things like children in your life. There is work. There's things that are inflexible, but sometimes just looking at what you need to do financially can continually go down. So that's what we have found at Sophia, is that what we've really looked at, and when we've talked to women, is looking at how to engage them in a way that kind of convinces them to bring that up, right? And part of that is things like using digital education. Women are very busy. And so letting them work at their own pace is one of those ways of engaging with them in topics that are meaningful around money in their life, their children, their retirement, their relationships, the introduction to investing. So we really look at that. The fact is, women like community. And one of the biggest challenges is that women aren't networked enough, whether they are looking at that from fundraising for their business or just generally even looking at their corporate environment. There's a need to network further. But actually, there's an extension of that into women like to work in a community, learn in a community. So what we've really seen is this power of using cohort mechanisms to bring women together, and you together bring that up. And we've just launched a program with JP Morgan's private bank. And part of that is bringing together digital education. It's bringing together kind of masterclasses and people together to learn with objectives in mind. Because where we've seen, even working with HSBC and Cartier Women's Initiative, when you run them in a programmatic way, year in, year out, you're just seeing such great results in terms of either the founders coming through those programs or the women learning and starting to focus on their financial situation. I would just say trust is really important as well. That's a big one. But we can educate as much as we want, but part of it's how do you move them to actually doing something with that. And that's where I think that community element, that trust element, and that looking at where people are in their life cycle as a micro persona is really important to then talk to them with the voice that appeals to them.
Yeah, and Nina, you have first-hand experience coaching female leaders. So in terms of grooming the next generation, what's your take on it? And also in terms of financial literacy, what's your thoughts on that?
Yeah, so my focus is on next generations, and if you look at even up to today, when you look at our younger women, there's still perceptions that men tend to be outside and women tend to be inside. You know, that's a saying in Chinese, and we don't normally talk about money, even for those of us who are studying finance or working in finance. It's funny how we assume. Or being assumed that men are the ones that gather and talk about investment stocks and properties, and women gather to talk about other topics. And so there are just not enough talk, like what Nicole mentioned. And I think the solution is really to have the right female role model. So that there is that trust level that they feel like they can talk about things that they may not be really knowledgeable at this stage about. And so one example that we at Women Trust, when we do events for our clients, that is a ESG challenge for university female young women. And the winning team got the chance to have a dinner with the portfolio manager who helped us work on that challenge. And interestingly, the portfolio manager asked that young woman, who was already winner of the challenge, what she wants to do. And she said she wants to go into portfolio management. And the portfolio management manager then asked her, well, then have you ever invest? And she said, no. Of course, she's about 19 or 20 years old, but still we can see there's that lack of opportunity for the young women to either she's scared or she doesn't have enough resources or tools to learn how to invest. And it is someone who is at the top universities here in Hong Kong studying finance. So other than that, of course, I hope at any education system, if we can have some financial literacy program for our students, that would be amazing. But unfortunately, it still rely on mostly the parents and the family, teaching their next generation on that. But last but not least, of course, a lot of mentorship is important for the young women to be able to share their challenges and talk to someone with a bit more experience and be able to find their path. So either in the career, in the financial management.
And speaking of mentorship, I think one important part is about the messaging in job ads or some of the sessions that you held. I think Nicole touched on something about pitching. I know the word pitching can be a bit intimidating for some of the female entrepreneurs. What's the experience that both of you can share? Like, what's the right messaging or the better messaging to attract female talent?
Well, I think, the use of marketing and the words we use is so important. So, for example, if we run a pitching event versus a mentoring event, we have so many more women sign up to join a mentoring event than a pitching event. We really struggle to kind of, the women that turn up are great, but we want to see more. But when we have a mentoring event, we see great women as well, but we just see a lot more. And, one of the other challenges is a high proportion of women run are sole founders. That's high investment risk, right? So key person risk. So there's a lot of need for women where the reason they're looking for that mentoring is they're actually looking for that advisory support. They're looking for someone who can, get them out of their own head, I suppose, but they're looking for that more advice that they're not getting, because when you're a sole founder, you're in that business day in, day out. You've got your ups, you've got your downs, it's a constant battle. And so looking for that advisor support is ultimately what they're looking for. And sometimes they kind of look at fundraising sometimes as that answer, but I think they're very intertwined there. The other issue where we see women struggle with fundraising is that predominantly a lot of investment is done through warm referrals. We've already talked about women not having a network. And so if they're not in this warm referral cycle, and I've read websites from investors that will say, if you cannot if you cannot find me in a different way for me to get investment from me, then you're not a very good entrepreneur. Now, to me, that smacks of stalking versus necessarily going out and saying I'm a good entrepreneur or not because I can get to that person. So that's a warm referral issue. We've got a lot of that where you're not seeing women where you expect to see them. And so we always say there's a party going on. They're not at your party, they're at ours, because we're seeing amazing companies through our businesses. And so they are out there. It's just we've got to look at the way that they're coming up in the system, because they're not at pitching, they're not in the warm referral cycle, which is where you find a lot of the businesses that are being invested in, which links back to why our numbers are so low.
Yeah, the important cohort, right? So that's what Nina also mentioned. Anything like you've done like that like, successful in terms of grooming or getting like a good cohort for female leaders?
Yeah, I think when it comes to a job post, for example, if any one of you is hiring, please bear in mind that there's statistics showing women tends to see the ad and only apply when they have 100% match. I literally refer someone trying to convince her to apply to a job, and she asked me if Chinese is a must. And I look at the ad, I'm like, yeah, but it's at the lowest of the list, so maybe it's not as high of a priority. Why don't you just give it a shot? But we all know that in general, no offense for the gentleman in the room, but men tend to just apply when they have about 70 or even someone said like 30% matching the criteria listed on the job ad. So for those of you who are hiring, I urge that if you don't think the criteria is really a must, please don't put a must there because you end up losing talents that can contribute. In terms of like bringing more women back to work, I of course like to urge all of you to also when you hire, please come up with more innovative offerings if you really want to attract different talents. And I hope that ESG is not just a tick the box exercise, and you really truly see the business case for bringing more diverse talents into the workplace. By bringing more diverse talents into the workplace, then you need to, for example, offer something like job sharing, which is rarely found in Hong Kong, and where two individuals will be sharing the same positions and of course splitting the salary, but then you end up providing more job opportunities to more people, and you actually have two brains instead of one in the job. And also providing a work-based, that's my dream, to have companies to provide work-based childcare facility. There are actually, as far as I know, only two existing in Hong Kong. And so it's definitely giving a lot of women that's good peace of mind to go to work when they know that the child is just at the facilities downstairs. And it also gives both the men and the women better access to be able to leave work on time to pick up the child, and then go home, settle the child, and then go back to work. I think if there's one good side product or side effects from pandemic is that all of us appreciate having a bit of a personal life. Before COVID, we all talk about work-life balance, and now I think we all talk about how work-life blending together. We all remember, the last Zoom we had, seeing a pet crossing the screen or the child, stepping in the room. So there are more empathy and understanding at the workplace, which is also very important for both women and men to really have a life outside of our work.
Right. I can definitely relate to the childcare piece. So in terms of getting, I think we can change the topic a little bit about starting a business. I think we touched on that, but at the same time, in terms of getting funding and FI, it's still difficult. Besides like having a cohort or a mentorship, what else? Like you two have like platforms, fundraising platforms, and so on. What are the challenges some of the female entrepreneurs have encountered, and what are the advice or solutions for them in terms of getting those their business started?
I think we've already mentioned one, but probably two is the kind of the warm referral cycle. I think the other one is obviously a lot of female founders are sole founders. So there's obviously and understandably from an investment perspective, there are concerns around that. So it's not like that should be negated at all, but there are ways to discuss that, and we talk to founders about that. There's some great research that's come out of London about prevention versus promotion questions. We actually work with investors, and we've done some training with investors, as well as helping women reframe this, but it's all around the way pitches are conducted, the way women answer them are in a very prevention-based manner. So it's very risk mitigation. And therefore, when you're listening to someone pitch, when you're thinking about investing with someone, you are looking at their data, but you're looking at that founder, you're looking for the dream, you're looking for that FOMO. You're seeing a lot of businesses each week, each day that you might invest in. And if that founder is very much talking about, well, I've got to achieve this before I do that, the prevention-based way of answering questions very much negates that kind of this founder is capable. And there's a lot of great research that shows when you remove the gender lens from that, It's all based on the way the questioning is done. So there's opportunities for everyone to relearn. So we actually talk to women and we help them reframe, a bit like media training on how do you answer questions, because this is a slow change, we'll be honest about that. But then it's great when we meet some amazing investors who are really interested in understanding how can we bring that into the team and talk about the way we do our questioning and kind of take that into the discussions we have. So that's really great. I think for women, what we also focus a lot on, and it really links into the whole conversation today, is the financial story. Women love building businesses that have impact. Women love investing in companies that make impact. There's a real drive in there. So one of the things when we talk to women, it's around we've got to move away from the problem, the solution, why you love this, to actually let's look at the financial data, what makes this a good investment. And so that's where we focus, at Next Chapter, a lot more on the investment literacy. So it's not so much, of course, you can capture, basic data in your business, but how do you take that forward and use that to talk to an investor and make funding decisions around whether you need some additional working capital, for example. And then at Sophia, we really bring that financial literacy discussion to life through the way we deliver our courses. So we really have a lot of female experts that come in. The majority are female. We've had a lot of compliments around even the backgrounds we use, very thoughtful in our videos, because we're really appealing to women. The branding we use, the terminology we're using. And so we're really proud of that because we put so much thought into that. Particularly, one of my co-founders here, Christine Yu, really was the driver behind the way the business looks. And I think that's a fantastic thing. So we've really taken a lot of time around that.
Nina, anything to add?
I really want to urge the male allies in the room to show more support and take more family responsibilities, whether you are married or not. I'm sure we have any sort of family obligation with the children, with your parents, and even show that level of a commitment at work. We all know, it's actually happening in Asia quite often, that despite the fact that men are given the right to have paternity leave, they don't necessarily like to take the leave. And so if for those in HR, then also can consider giving more flexibilities. Oftentimes, I remember my husband, when I gave birth, he mentioned that he felt like he had no use at home. Because we have the confinement lady, we have my mom, and then we have the migrant worker helping. But that him being present there is important, and also later on, as the child gets a bit older, then you can share more responsibility. So please bear in mind, you can also pick up some role at home.
So there are big things we can do, but they're also being present. I think that's the important piece of, being the supportive to female in business, in startups, at the workplace. Any final thoughts? We have about 30 seconds.
For me, it's always around this is an opportunity. We've shared some statistics that show there's a need there. There's a need to talk to women in so many ways around money. And when you look at younger women, they defer their control of money to their husbands, which they don't, because they feel a lack of confidence, but most people in their 20s don't know how to invest. That's something that comes with age and time. So I think there's a real opportunity to engage with women very openly on this, and don't be nervous about that. Just, there's so much opportunity to really go out and talk to women openly.
Okay, thank you so much, everyone. Thank you, Nicole. Thank you, Nina. Thank you so much.
Please welcome to the stage Cece Liu, founder and CEO, VenLink, and Edith Yeung, general partner, Race Capital, for a conversation with Bloomberg's Brad Stone.
All right, hi everybody. We're here to talk about wealth and Web3. It feels like a very topical and urgent subject right now. We have Cece Liu, who's the founder and CEO of VenLink Partners. She helps institutions from investment banks to wealth funds to help them navigate this new digital asset environment. And Edith Jung, a general partner at Race Capital, an early stage venture capital fund. Edith is a legendary investor and backed such blockchain companies like Solana. So thank you both for joining us.
Thank you.
I find it useful whenever we're talking about Web3 to start off by defining our terms, because it can mean so many different things to different people. So Cece, do you want to kick us off? And we don't have to belabor it, but what is Web3 right now?
I mean, the Web3 definition changes every 2 months. Like 2 years ago, there's no Web3, it's the Bitcoin, Ethereum, and then turning to now it's covering tokenization of digital assets, anything that's run potentially run on blockchain, can be powered by smart contracts. These kind of are tokenized concepts. And I think anything related to these kind of new financial innovations can be called Web3.
Okay, Edith, let me turn it around. What do we normally think of, or what did we originally think of as Web3 when the term was defined, that you feel like it's not Web3 anymore?
I spent most of my time in Silicon Valley, so my definition is quite geeky. So to me is like thinking about Web 2 is really owned by the big platform, like the Google, Facebook, Amazon of the world. And if you imagine like Facebook basically monetize all the user data and none of us get a piece of it. So the whole idea of Web 3 is really about decentralization of the internet, where you and I should actually own a piece of the data and decentralize Facebook, decentralize Twitter. Like, why do all these big platforms own all of the data then, but we don't own any of these? So therefore, when I look at Web3, it's really about the building block of, so like the Solana of the world is the layer one, which is the foundation where the sort of distributed or decentralized application built on top of it. And there's layer two related things all about scalability. There's custody, security, and many facets of what define Web3. But I think in Hong Kong, and let's say if I am Hong Kong government, is mainly really focused on crypto exchange, digitalization of assets, and a little bit different of how we look at it as an early stage venture.
There's a feeling in Silicon Valley that the air has gone out of the Web3 idea. The conventional wisdom is, that we've all moved on to AI, and we'll talk a little bit about that later. But is that, from your perspective, is that wrong? Is it way too early to dismiss Web3?
We're sitting in Hong Kong, and there's a reason why we're here. The mood in Silicon Valley or in the US is a little bit dire. There's definitely a big cloud over the industry because a little bit undefined legal framework and how that's going to turn out. But having said that, there's still big platforms are not giving up and still pushing the envelope. PayPal did an integration with MetaMask. You look at Interactive Broker now actually support to let Hong Kong retail investor to trade crypto. Robinhood, the Venmo of the world are still sort of supporting it. But I think the key theme of this year is about regulatory and compliance in the US. Very, very different mood compared to being here or in Singapore, where the government really wanted to support it and want retail customers and put together all these safeguards to get everybody to be on board in crypto.
So I want to start a poll question and get you all to vote on this, and then I'm going to ask, as you all vote, I'm going to ask Cece and Edith this question. The poll question is, and I'm going to tinker with it a little bit. What portfolio allocation would you currently give to digital assets such as Bitcoin? And we've got 1 to 2%, 3 to 5%, more than 5% for the real gamblers. But Cece,
wow.
You're advising funds on Web3 and digital assets. What's your answer to this question?
I mean, I think Bitcoin obviously has been recognized as digital gold, and the scarcity defines the value and then supply and demand. And even though some people may argue that there's no intrinsic value, but we'll buy luxury cars, luxury watches, luxury bags. What's the intrinsic value really behind these brand names, right? So I think for that reason, I think human society makes Bitcoin the value will hold, even though there's no really intrinsic value. Even though they're making the ecosystem have the BRC tokens now to have some utility on the blockchain. But I think comes to investing in digital assets, if you're talking about crypto assets, it's really important to have a diversification and also active management. Before the market collapsed, a lot of people say, well, just the top 10, market cap crypto assets. But then, top 10 crypto asset 6 months ago may not be the way going forward. Like, for example, Dogecoin, right? This is in the top 10. Like, for example, in the last month, there's a Pepe the Frog coin.
Yeah, perhaps. Skip that one.
Yeah, exactly. So you can't really define crypto asset based on market cap because it's so volatile. And to really understand what's the utility value of that project creation is really important. And also the tokenomic design, like it's saying, the Web 2 and the Web 3 is a new way of kind of define who owns what, right? The Web 2 of the world controls the shareholders. It's all about shareholder value enhancement. The Web 3 is about stakeholder. It's about everyone in the ecosystem. You can be a service provider, you can be a user, or facilitating some sort of a service. And everyone, in theory, should share a portion of the wealth. And that's kind of really the definition between Web 2 and Web 3. So I think people should have a diversified.
If you're voting here, where are you putting the allocation?
I think this has come to the CFA time. It's like depends on your time horizon of your investments and your risk appetite, and also when you need to buy a house or paying tuition, and that's still play the old finance theory still apply to Bitcoin. So yeah, it depends. If I were me, more 5%, more than 5%.
Edith, what is a conservative but diversified approach to digital assets right now?
I think my answer for this one is it depends. I just spent some time in Brazil, and because of political instability and the currency devaluation, actually is 100% in crypto. Because locally, if you are holding Brazilian real, you may actually will lose half of your net worth if you just hold that in the local currency. So in that sense, it really depends on what region that you're in. The more established the financial system is, then you're probably much lower. But you can imagine in certain developing country, this is actually core of
And
the
if you're
financial
sitting
system.
here in Hong Kong, where would you put the allocation?
I think a handful of my friends who are local family offices, they are actually in sort of the 1 to 5%, where, as CC was saying, Bitcoin is like digital gold, so they hold it long term.
So Edith, we're coming through the crypto winter when a lot of the trusted institutions in the digital asset field kind of radically squandered the trust of both investors and customers. And you were, I talked about Edith's sterling investment record, but her firm was also an early investor in FTX. Mm-hmm. So what can the audience, I guess, and what lessons do you draw from the collapse of an institution that seemed at one point to be pioneering this new field?
It's crazy to think about, similar to SVB, which I last checked, it was valued at $34 billion in 2022.
Silicon Valley Bank.
And FTX was valued at $33 billion. And both of these big, you would consider too big to fail, disappear in 2 days. So I think like the biggest thing learning, especially for this audience, is definitely don't put greed in front of control. It's really about separating church and state. And there's 3 things. One is if some of you are continue to bullish on crypto, really need to separate. A trading platform is not a bank. And you should really, number 2 is to work with custody provider. That's why we invested in standard custody of PolySign in the US, where you should pay somebody who are expert to go protect your asset and don't put it on just the platform. And number 3 is so similar to now all the startup in Silicon Valley, need to think about treasury management. You can just, obviously I love HSBC. At the same time, you cannot just bank with one. You need to have open account in multiple platforms to make sure that you can hedge against, just in case if SVB doesn't work out or FTX doesn't work out, you have other platforms that you can work with.
Cece, do you think the industry has internalized some of these lessons from situations like FTX and is at a point where it can credibly re-earn customers' trust?
Yeah, absolutely. I think not just the banks are involved in providing custody service. I think that's a great idea because banks been custodize assets for the society for decades, right? So you have the trust and you have the proficiency in the cybersecurity measures to do the business. And in addition to that, the industry bodies like industry bodies are issuing like a consultation papers like ESTA. So outlining the guidelines of how you should custodize digital assets, specific features like airdrops, like forks, etc. So I think with overall the whole traditional finance getting seriously involved along with regulators, I think this ecosystem is becoming more mature. And also, I think, that's why I think education is so important, because with the big banks to involve, then obviously will push this industry move forward faster. But within the internal stakeholders, if you have a different understanding of certain concept, it's really hard to kind of move the speed that they want to. So education is important to get your employees up to speed so they can be relevant for the financial innovation, and everyone can thrive in the new financial ecosystem.
Well, let's stick with the regulation piece of it. I'm just struck, and maybe you can explain this, Cece, why the government here in Hong Kong and in China is taking such a dramatically different and perhaps more open-minded view of digital assets than what we're seeing in the US, where every day is another SEC lawsuit against companies like Coinbase and entrepreneurs threatening to move out of the US. What is going on? Let's start with here in Hong Kong, where they're ready to start licensing exchanges and perhaps creating some new tokens. Why is it so open-minded here?
I think I'm really, really happy with how HKMA is coming up. This is very speedy evolvement since the end of last year, basically regulating the virtual asset trading platforms, figure out how to involve retail investors and how to regulate stable coins. And I think that is really, really great. And also, obviously, Hong Kong's related to China. In China, like blockchain, Web3 is part of the next 5-year plan. And then we all know from 2012, when China started pushing the digitalization of the economy and really lift the whole economy to a next level. And then that's why we see the wealth generation in China. And they don't want to just stop at on the internet. They want to move the society to the blockchain, and that's very clear. And I think having Hong Kong to have access to the world, it can be a test run. I don't think the policy is going to do a U-turn, even though they banned crypto, they banned mining, and then I think there's a reason for it, because in mainland China, the financial structure is not mature enough and such a big population for people to gambling the cryptocurrency. And as we've seen happening last year outside China, so I think overall, I think that's great. I think it's very positive in Asia. And US, obviously taking regulation by enforcement, different departments of fighting power and finding people. Yes, kind of unfortunate, yeah.
Well, Edith, I want to ask you a different version of the same question, which is, what sort of internal goals are the governments in Hong Kong and China pursuing with this kind of radical open-mindedness towards digital assets? Like, what does it, aside from the innovation and financial opportunity, what ends are the governments, what opportunities do they see in digital assets?
I think Hong Kong government, for sure, being the Asia, financial center of Asia, if you have clear policy, regulatory policy, you can attract good actor and good business that you want to see. the more clear you are, then all the bad actor will go away in some sense. But the most important part is that if you really sort of get it right, then you can really drive like true financial system and really get, let's say, the digital RMB. Can you imagine like the rest of the world start trading, using this currency instead of US dollar?
Interesting, okay.
And the sooner to you be able to sort of enable the world be able to transact, why am I still paying $15, $45 to wire transfer from San Francisco to Hong Kong if I can just, peer-to-peer, of course, with full-blown KYC, AML, and basically cut down that time to seconds and super zero costs. That really is a real pain point that I think the government realized that if they can achieve that with the right framework, they could be leading the way for the rest of the world.
Interesting. And Cece, I mean, this is such unexplored territory. Are there also like serious economic risks that accompany this experimentation? It's maybe things that we can't even imagine.
You mean the CBDC experimentation? I mean, yes. I mean, definitely. Like, for example, the design of the eCNY, is like 2 tiers instead of a direct CDBC, like a lot of European CDBC is exploring. So basically, they want to maintain the financial stability in the banking system as is. So central bank will be issuing the eCNY. However, commercial banks, telecom companies, or payment platforms will be distributing the eCNY. So they still keep the banks relevant, right? And they want to make sure, the eCNY doesn't bear interest. It does not compete with cash, physical cash. Why is that? Because if the adoption of eCNY suddenly become very high, people don't keep the deposit in the banks anymore, right? It causes credit squeeze or narrow banking. Like in a different way, like what's happening in the US. So they are very, very carefully designing these kind of elements. Another thing is the fiduciary duty of who's looking after the crypto wallet, right? It's not your. It's not your wallet, it's not your coin. So yeah, so like for example, I lost my phone today in the taxi, and if I had the only digital RMB in my wallet, that would be more devastating than how I'm feeling about that now. So that definitely has a lot more to study, a lot more to research before it become, the whole society adopting the.
Yeah, I mean we've just seen in the U.S. with Silicon Valley Bank and New Republic Bank and Signature Bank, how swiftly customers can lose trust in a financial institution and paradigm.
Same as stablecoins. Luna and Terra, the same loss of trust.
Right. We're at a conference and we're talking about technology, so we really need to talk about AI.
Of course.
Edith, well, let's stay with blockchain for a second. Is there a marriage here of the 2 great tech trends in the last 5 years? How does AI inform the kind of blockchain companies and opportunities you're seeing now?
For your sake, I brainstormed on a whole bunch of ideas. Can you imagine ChatGPT be able to take a wallet address and figure out all the activities associated to it? Or basically ask ChatGPT to go through the entire Solana blockchain in the last 24 hours to figure out what are the NFT activities? Or I guess one of sort of the marriage of IP. And can you imagine, I'm like addicted to Midjourney.
It's remarkable if you haven't experimented with it. It's incredible.
And I will create, let's say, a car on Yoyogi Kusama that looks like a beetle. Mm-hmm. And in this case, maybe it recorded on the blockchain, will IP come from where? And that is a beautiful marriage of both worlds.
So protecting IP, even though so much of AI and generative AI right now feels like it's undermining IP.
Yeah, and maybe if it's recorded on a blockchain, if there's any sort of commercial and revenue, then everybody will get a cut and is actually on a public ledger. That makes a lot of sense to me.
Cece, where do you think the marriage is?
Yeah, right, definitely. I feel for blockchain or smart contract to run, one of the big things you have to connect to the real world, right? So it's like what you call that oracles. So you have, especially banks using blockchain or smart contract, you have to feed the data, the real market data. So with AI, perhaps that can make it more efficient and more accurate. And like, for example, like, like there's this big struggle for the ESG push, right? The green bonds, everyone is talking about it, but essentially it's really expensive for the issuer, for the syndicator, and for the asset managers to really own a green issuance, right? And then with AI, I don't know, maybe it will help to collect data, verify data, and become hopefully more cost efficient in the future. Yeah.
Edith, I want to start including some of the wonderful questions we're getting from the audience. Would you share your most successful crypto investment so far? Is that got to be Solana?
Yes, Solana. I love Solana. And plus, they just launched a phone called Solana Saga.
Well, maybe a phone, did you say?
Yeah.
And maybe CC can have it as her replacement for her iPhone.
Yeah.
I mean, to be honest, I invest in a crypto fund. So I prefer to have professionals to look into this space.
What's the most exciting opportunity, though, that you've identified in your years in the space?
I think there's a lot of like derivatives on the blockchain, and I think like for example, earlier we talked about everything investments about cash flow, right? So you invest in a portfolio of crypto assets. If you really know their fees they're generating, that is a great indicator that there's a real world use that people are paying for it. And that's the whole point of Web3. It's not free. Web2 is a free in terms of like you don't have to pay as a consumer, but your data is being used, right? So Web3, like no one's using it for free. If you use this blockchain or protocol, you have to pay. So as a result, you can really track which projects are thriving or really having real traffic by the fees that are generating. And then because it's on the blockchain, because it's transparent, you can actually see it yourself. So that is, I think, is a great way to find investments in crypto assets. But I still have to actively manage because, for example, Luna was great for maybe, 6 months or a year. And you can't just say, oh, it made me this much return, then I'm going to keep it and not look at it in 2 years and it will be gone.
Cece, what's your view of this new generation of tokens that are tethered to traditional financial products like deposit accounts versus stable coins, which are traditionally tethered to fiat currencies or other cryptocurrencies?
Yeah, so like JP Morgan is doing tokenized deposit, right? So, I think it's interesting and then it's something very embraced by MES in Singapore, but then I just found this hard to understand how it can be interoperable with other banks unless other banks also doing the same thing. And
that's unlikely.
Right, so then how do you just basically, instead of wiring the funds, you change tokens? I understand maybe reduce the settlement cost. But I think stablecoin is a very different, it will be used in a different world. I don't think stablecoin will ever replace fiat. And the stablecoin going to get regulated this year going forward, and I think it will be really interesting to see which stablecoin will be left by the end of next year, for example.
Edith, do you have a view on traditional financial institutions like JP Morgan minting their own tokens?
It's super interesting. At the same time, I think we should sort of separate where, there are things that is really for the whole concept of for wealth, like preservation, which I think, as many family office here locally is mainly focused on Bitcoin, versus on stablecoin, let's say in the US, USDC, USDT. A lot of the, still like the highest trading volume is actually USDT, is because people are trading and doing a lot of arbitrage, going in and out, mostly using for crypto trading. So the purpose of each is a little bit different. Me personally, I think the whole looking at least what government is pushing for is really a one-to-one real asset-backed stablecoin. And I think that's what sort of worldwide to sort of protect the community is to make sure that you don't just create vaporware.
Well, I love ending these panels on big, bold predictions, and an audience member has given us the perfect question. So we'll end on this. Could Bitcoin replace the US dollar as a global currency in the next 20 years?
No.
No, no way.
Okay, there you go. Cece, Edith, thank you very much.
Thank you, Brad.
Please welcome to the stage Calvin Lee Kwan, Director of Sustainability and Risk Governance, Link Asset Management Limited, and Rakesh Patel, Founder and CEO, Alta Capital Real Estate, for a conversation with Bloomberg's Crystal Chia.
So, right.
Hey, so the WHO declared COVID, no longer a global health emergency last week, and the wellness industry that took a hit during the pandemic, it's now expected to grow to hit $7 trillion by 2025. So we have health and wellness, and then we have real estate, which we're going to talk about today. How do these two sectors overlap, and how is that showing up in what you do? Maybe we can start with Rakesh.
So thanks for having us today. I think on the wellness side, first of all, wellness was already a pretty strong trend pre-COVID. I think what's happened during COVID is people have now realized the vulnerability around their kind of physical and mental fragility, if you like. And so post-COVID, I think the trend is accelerating. People care more about their physical wellness. Definitely more conversations around mental wellness and health, if you like, as well. So you look at GWI data, wellness overall growing by sort of 10% CAGR, and places like wellness tourism, 20% CAGR. So in other words, accelerated growth rates, I think post-COVID versus pre-COVID.
And for Calvin, for you, I suppose the way that you are marrying real estate with health and wellness got to do with commercial real estate, tenant demand. Are there any health and wellness building certifications that investors should be looking at?
Thanks, Crystal. First of all, I think a lot of things that Rak has already mentioned for the hospitality side completely transfers over to the commercial and retail side as well. Prior to COVID, there's obviously LEED certification in Hong Kong. We have Hong Kong Beam Plus certification. And right around 2016, 17, 18, there's been a lot of focus on the wellness certifications. So there's WELL coming out of the US, FitWell as well. And in the real estate sector, there's a Global Real Estate Sustainability Benchmark, and they've actually started factoring in health and wellness into their assessment of portfolios, real estate portfolios around this world. And similar to what Rak has mentioned, the demand and expectation now, it's probably expectation of health and wellness in the commercial real estate sector has actually skyrocketed. The other point that I would probably add is this whole need and desire for social well-being, social inclusion, collaboration, connectivity. And this is something that we're seeing kind of take place more after COVID.
When you talk about health and wellness as it relates to commercial buildings, how would that look like? If I were to step into a building and it's well certified, what does that look like?
Well, ideally, you couldn't tell the difference, right? Because we've implemented and integrated into the building itself. Now, I think that when you look at it from a few perspectives, from an environmental perspective, the key is going to be air quality, right? Can you walk into a building and breathe in there without feeling that, there's some dust, the air is stale, or is it fresh, right? From another design perspective, environmental side is about having open lighting. Natural lighting is much better than artificial lighting, and this has been linked to productivity for your own staff. Now, I mentioned earlier about the point about social well-being as well. And some of this is really just about how you design the building. A lot of buildings, just from an efficiency perspective, are just square blocks and just built vertically. At Link, we've actually looked at it in a different way. How do we encourage social community, social well-being? So one of our flagship properties, the Quayside here in Hong Kong, is a design. It's actually 2 towers, but they're turned 45 degrees so that right in the middle, they actually connect. So yes, 2 towers, 2 connecting towers. And in the middle, because they connect, you now create a very broad space that can now host a lot of functions and activities for different offices, different types of tenants. We at Link, we're also in this building. We've turned that into our social hub where the teams communicate, collaborate on different projects. We're noticing that our tenants appreciate having a property where the floor plate can be big enough to create these social event activities as well.
Right. Now, all this sounds great, but if we think about it, what's the longevity of these health and wellness investments in real estate? During the pandemic, I assume that the spa industry just basically disappeared for a period of time. And I know, Rakesh, you have various retreats and projects around the world that kind of deals with this wellness industry. Yep. So would you like to talk about how you keep your investments sustainable?
Maybe a couple of things to follow up on what Calvin just said. So we look at it as investors, do we make a return by doing the right thing? So from Calvin's points here on the office space, and he's obviously an expert within the office space, is we look at data, there was some MIT data that said if you are in a well building, office building, accretive rents are around about 4 to 8% versus a non-well building. So there's a kind of a return argument for doing the right thing, right? Within the wellness space, given we don't think it's a cyclical rebound, we think it's actually a structural growth area. So people are actually going to be searching for those wellness opportunity solutions. We think that's an area we want to be invested in, right? So we invested in a wellness retreat in Thailand last year. And already what's interesting is the wellness packages we saw at the retreat in 2022 were already 28% above 2019. So that's not just a cyclical rebound, people searching for wellness, that's actually a structural growth trend as well.
And where are your clients coming from?
Interestingly, the guests that we have, the makeup is actually 80% Caucasian, so from Europe, Australia, 80% female, and 80% 20s, 30s, and 40s. It's a very specific demographic.
Demographic, indeed. Right. So in terms of, we're talking about the sustainability of these investments, I have to bring up this concept of well washing, right? The term itself kind of tells us it's equivalent to greenwashing, but in the wellness space. It's not so widely known yet, and I guess it's not really been defined clearly in the industry what exactly is well washing. So maybe Calvin, you can tell us what's your definition of well washing.
My definition of greenwashing. Well, I think the first thing, we can look at it from a regulatory compliance perspective, right? If there are certain regulatory compliance issues that we need to report back on, and it's clear that we're not meeting those standards, but saying that we are, I think that's definitely going to be in lines with greenwashing. I think we have to be careful from a marketing advertising standpoint to say, oh, we are a sustainable company, because there's a lot of things that you can get caught for not being sustainable. It is at very fine balance. I think I agree with you that it's undefined. Over in the UK, a lot of the greenwashing litigation has actually come from the advertising regulators. Right? Whereas in Australia, it's going to be a different group of regulators that are doing this. And then from a listed company perspective, we already have SEC, HKX, Singapore Stock Exchange, having all these ESG compliance requirements as well. So there's good opportunity and unfortunately risk for greenwashing. The key is actually just to make sure that you walk the talk and practice what you preach.
I'd just add to that. I think greenwashing ESG, it's becoming more obvious that actually some companies are claiming to be green or have ESG credentials where actually they're not delivering. So you're seeing more, for instance, ESG funds having to drop the ESG acronym because they're not delivering on that mandate. From a well-washing perspective, a similar story, right? In other words, people are promising something, companies are promising something, not delivering at the same time. And I think this important piece around promising execution and transparency and accountability, super important.
And what are some specific examples of well-washing that you have seen, Rakesh?
So as an example would be, without naming names, of course, right, would be that a building would claim to be a space where employees are comfortable feeling well, but then you look at the employee surveys and they don't match what the corporate is saying. That'd be one example. On the other side, of course, is that within the wellness space, you're claiming to have a wellness type product, but it's really just an enhanced spa, like a spa plus plus. So there's kind of two ways of looking at it. But I think the most important thing is be transparent, be accountable.
And Kevin, how can investors spot well washing as opposed to, what would be called a real wellness investment?
Well, so I think investors are getting more savvy about this, especially European investors. And it comes down to, number one, being open and transparent. That's the first way to get around greenwashing or well-washing. Because that means that, first of all, I'm telling you what are the important things to us, and I'm telling you how we are addressing these. I think there is an element of authenticity as well, saying, look, we're on our journey there. We haven't achieved it, but these are the targets that we set. This is how we're getting there. In the end, it's also about understanding our investors' expectations of us on green issues, and having the transparency and accountability to let them know this is probably how we will meet those expectations. So one of the key points for a listed real estate company would be this concept and issue of climate resilience, right? Are you assessing your portfolio to climate change? What does that mean? Well, for us, we've actually gone through and done a flood assessment for all of our entire portfolio. And from that, you have the quantifiable information to say which properties are at risk, why, and better yet, now that I have this information, how do I go back and mitigate this risk so that from an investor's perspective, I've helped reduce that risk and hopefully continue to generate steadily growing returns.
Okay, so if we could shift the conversation a bit from the wellness space to more of the real estate space. The real estate investments have long held the narrative that it's a hedge against inflation. Right? Everybody wants to own a property. Is it still a hedge against inflation?
So you've got to break real estate down by different segments, of course, right? So within the office space, clearly it's challenged right now, an office building space, given that funding costs are rising. So you look at New York, you look at Europe, values are tending to go down, particularly B and C grade offices, right? In the hotel space we're in, it is more of an inflation hedge. So I was in Europe recently. If you look at ADR's room rates in Europe, they're up 20% year on year. So that's way in excess of the inflation picture, if you like, right? So it depends on the space you're in, but historically and even today, you can see that hotel investment tends to be a better inflation hedge than maybe other parts of real estate.
Calvin?
And likewise, I think it's going to be a little bit about how the makeup of your portfolio. So Link's portfolio, primarily non-discretionary retail. So everybody still comes to our properties to do shopping and purchase products. The other thing is we're seeing this boom in e-commerce, right? And then that naturally leads to logistics and so forth. So it's really a matter of how you manage and put together that portfolio.
And in line with the theme of our summit today, where and what is the nexus of wealth creation in Asia? Rakesh?
So I'm obviously slightly biased to the space we're involved in, right?
Yeah.
But one thing I will say, if you look at kind of UN data, the middle income on the middle class segment within Asia is clearly booming, right? So the consumption, that segment will double by 2030. There'll be 1.5 billion millennials in Asia by 2030, right? So from an investment standpoint and a hotel standpoint, we want to be exposed to areas which is going to cater to that behavioral change and that customer segment. So we obviously feel things like lifestyle hotels, which we do, experiential, wellness is the product people will demand, as in this growing segment. So that's what we have exposure to in the fund. So for us, that will be investable.
Calvin?
So obviously I'm going to be biased as well. Real estate, of course. But also beyond that, it's a little bit of understanding how real estate will have to evolve. We've talked about task force on climate-related financial disclosures. What type of real estate properties are buffered against climate change? But moving forward, we have a few other issues coming up, right? Nature-related financial disclosures. There's a growing effort to put together TSFD, Task Force on Social-Related Financial Disclosures. And what I'm getting at here is those real estate, those companies that can understand how nature and social issues will impact and influence their portfolio and react quickly will naturally be performing better and actually create more value for investors in the future.
And what do you mean by how nature and social factors would impact their portfolio?
Well, so I kind of gave an example earlier on in regards to building an office building, right? Instead of building two single towers, we did realize and feel that social interaction, social integration is going to be one of the key things moving forward. So again, twisting the property 45 degrees, connecting them in the middle. You've created more space that's usable. And we deliberately made sure to design that it was a pillarless. So it's almost one continuous floor plate, 50,000 square feet. And with that, that means that any tenant that comes in, they can repurpose, reuse, design that space to be much more interactive. For a lot of us in this room, to put that in perspective, if you go into a building that's square, typically right in the middle is going to be the elevator shafts, right? So you go up there and then you have the office space around. Typically one side of the office never meets the other side of the office, and they don't congregate. But with looking at a social perspective from a design, right at the very beginning, you can encourage that you can facilitate that type of behavior. So it's, again, anticipating what's coming. We think that social interaction is very important. How do we put this into our design? On the nature side, is really going to be, how do you look at real estate? Is it just a building? How do you look at the surrounding communities? So in Hong Kong, we have Beam Plus, which has a rating called neighborhood certification. LEED has something very similar as well. And the concept there is about how do you build your property, your real estate, develop it in a way that integrates with the other, I would say, neighbors or partners around you as well, to truly create that community, right? So then you're dealing with nature issues, you're dealing with social issues, and it's shown that these type of locations tend to be a little bit more resilient, because it's not just one standalone property, it's actually almost a master plan development.
I would add to that just from the social aspect, right? So in terms of hotel product and development, definitely the trend is towards more social spaces, right? We see that all the time, right? So in other words, where people can congregate and be together as a community, that's important. Even within the wellness space, we find when we have people at our retreat, the more time they spend together is part of them actually becoming well. So there's definitely a trend there, which I think is really accelerated post-COVID.
And I suppose that will also drive your clients to come back for more retreats as well.
Ultimately, repeat customers is huge, right? Yeah, and therein comes the return accretive part of it. So you do the well thing, of course, right? But you've got to make a return on it. Yeah.
So all this sound like a massive effort, right? You have buildings facing 45 degrees, and you have sprawling retreats in Thailand. What are the challenges investing in health and wellness real estate as opposed to investing in just real estate? Rakesh?
Yeah, it's a harder space, right? I think that the difference is for me, when you're investing in an office building, it's relatively binary, and things are quite transparent. When you're investing in a hotel product, particularly what we do, you're actually investing in experiences, and copying and pasting experiences is a harder thing to do, right? So people are now searching out not just a box to stay in a hotel, but they're searching out an experience, and actually managing to maintain the experience, copy the experience is the really hard thing to do. Doing a box on a bed is relatively simple to do, right? So we're taking on the more challenging part. We feel like that's a better place to get returns, but it's definitely harder to do.
And Kelvin?
Well, so for us, it's a little bit more straightforward.
Yep.
The key challenge would end up being actually understanding and anticipating where our stakeholders, in this case tenants, how their mindsets, expectations will shift and change over the next few years. We have a concept called mindset called business as mutual. Right? How do we do things now to enable or help facilitate our business partners? So with our building designs, from a design perspective, it's much easier. We get well core and shell certification. And when we have that, it actually brings in tenants who care about health and wellness. But not only that, because we have that certification, it actually also helps those tenants that might want to get certification for their own spaces. Right? So we're helping them meet some of their objectives, making it easier as well, that whole business as mutual approach. And that works for buildings that we develop. A lot of our portfolio are going to be acquisitions, and that's going to be a little bit more challenging because you have to renovate, update, and refurbish properties that are still operating with tenants in there doing business at the same time, and getting them on board with how we're doing this. The final product will be, better, and explaining them to why it will be better. So the existing portfolio that we had, which is kind of what you've hinted at as well.
Yeah.
Got it. Now, at this point, I would like to prompt the audience to ask any questions that you might have. And moving on, Asia, we have so many cities, and both of you have presence in different countries, different cities, especially for Kelvin, you're all over Asia. Where in Asia would you invest right now? So I know for Rakesh, it's a bit more complicated because if you're opening a retreat in Thailand, your clients are actually coming from elsewhere anyway, right? So where would you invest in Asia now?
Look, we as a fund, we're opportunistic. So we're looking for value. And so when you look at the whole real estate space, hotels across Asia, we find the better value in Southeast Asia from an investment standpoint, and also Japan. So in other words, an ability to meet our return hurdle. So we're quite strict about actually what we invest in. So country-wise, I would say definitely Southeast Asia and Japan. Product-wise, definitely lifestyle over mass market. Mass market is quite price competitive. Lifestyle, you can definitely add value. And then in terms of urban versus resort, we go for resort. Once again, urban is a bit more challenged given business travel is not coming back as fast as people are expecting. So from a macro perspective, it's those countries, and it's lifestyle, and it's resort. That's where we find the value.
What's the difference between lifestyle and mass market?
So lifestyle would be where you can experience something. So as an example, a wellness retreat, a boutique hotel in the hills, maybe a funky lifestyle art hotel. That'd be lifestyle, experiential. Mass market would be more like a business type hotel, or like a 2 or 3 star product catering for mass market tourists. So we find this space very price competitive, and that's not a game we want to be in. We want to add value in the lifestyle space.
And Kelvin, where would you see the opportunities in Asia?
Well, as a real estate investment trust, our objective is to provide steadily growing returns for our unit holders. And we look at Asia Pac for a couple of reasons. Number one, it's well understood that this region over the next 3 to 5 years will really be the growth driver for the world. We focused on Hong Kong, mainland China, and Australia. Most recently, some of you will know that we've also entered Singapore. Our focus is to make sure that we have that resilient income. Some of this is going to be based on what types of properties to invest in. So our approach is going to be different from Rex, right? You're looking, you said you're steering away from the mass market, where for us, we're looking at non-discretionary retail because that's consistent and that's what generates return. I've mentioned a little bit of looking at some of the trends that we see, online shopping, e-commerce, and naturally how that might take away from the retail space. But then that means that there will be more opportunities in the industrial and logistics space, which is why we've also invested in those types of properties in mainland China as well. On the office side, I think that right now, especially in APAC, we're seeing a lot of people return to office as opposed to work from home for various reasons. We're also seeing tenants revisit how they use office space. There's been concern that tenants would cut down on the office space that they have because they don't think they need so much. But we're also seeing tenants say, actually, we need more because we can't have this crowding. We want that social interaction. So that's going to come down to making sure that you have those prime office locations that are in the CBD areas. The last point I would add on this is I've mentioned about the point about social changes, right? And what we're seeing is the focus on health and wellness. People are finding different ways to go to work. In Australia, a lot of people like to cycle to work, run to work, walk to work, whatever it is. And from that, we're seeing a demand for end-of-trip facilities, meaning that once you're cycling in, imagine cycling Hong Kong in August, right? Once you get to the office, you actually want to take a shower and so forth. And we're offering these actually at our office locations in Sydney. I mean, this is one way of catering to that demand. And because we have that, some of our tenants appreciate that and decide to move their offices to those locations.
Right. Now, because you mentioned expanding into Singapore, I have to ask that dreaded question that's been asked 1,000 times. Do you think the Singapore property market is becoming a competitor to Hong Kong's property market?
So will Singapore's property market be a competitor to Hong Kong's? I think that there's a lot of similarities. And the way that we invest, we invest in commercial retail properties. And I think that both those markets have very strong demand for obvious reasons. So I don't think it's necessarily competition, but I think that it's at least good locations to compare and review how we might do better, how do we learn from one location and bring that experience to the other location as well.
I would just add, I mean, just from an investment perspective, a value perspective, we find limited value in Singapore at this point. So cap rates are super compressed, right? And so getting a return on real estate in Singapore is tough to do. So we would, at this point, not invest in Singapore.
Right.
But that's just us.
Okay, understood. Okay, we're running out of time. Just one final question. How do you stay healthy and well? I personally meditate almost every day. What about you, Rakesh?
I go to a wellness retreat.
Okay.
Yoga, meditation, and gym, and then trying to find healthy food options in hotels, which is actually normally quite hard.
Agreed. Kelvin?
It's got to be eating healthy. We're in Hong Kong, and Eating
so much good food here.
Yep.
Eating healthy. Okay, may we all stay healthy and well. Thank you very much.
Great, thank you.
Thank you.
Thanks.
Please welcome to the stage Chiman Kwan, Group CEO and co-founder Raffles Family Office, and Stephanie Yun, Managing Director and Head of Hong Kong and Dallas, for a conversation with Bloomberg's Mark Cudmore.
Good afternoon. Thank you so much for hanging around for this one. I'm really, really excited by this panel. Talking to these two guests, they are the perfect people for this discussion on the generational wealth transfer. Chiman, I think, comes from the wealth management side, but is at the forefront of the wealth management moving into digital side. And Stephanie is at the digital side, moving into the wealth management side. So I'm simplifying it there massively, and they're going to quibble with those descriptions, but that's roughly how it works. I think this is just a massive event, the amount of wealth that is transferring between generations, and it's a younger, more educated, digital natives. So I think I'm going to go, Chiman, to you first, and I want you to kind of give us some kind of definition here, or outline some of the opportunities that we're going to see in this generational wealth transfer and what people need to be aware of for that kind of opportunity to capture.
Sure. Thank you. I'm Chiman. I'm from Raffles Family Office. So I think one of the key things that we've been asked, why is everyone suddenly looking at this industry at large, right? And I think one of the numbers I always look at is as Raffles Family Office, we are always very focused on Greater China, Asia as a whole. And if you look at the bigger number, in China alone, the so-called the ultra high net worth, they hold about 160 trillions of wealth. That is about 1.6 times of the GDP in China. And then if you look at the amount of wealth that's being transferred from one generation to the next in the next
160 trillion, which currency?
Sorry?
How much did you say there?
US dollars. Yes, always US dollars.
Just making sure. Wow.
So in the next 10, 20, 30 years, in China alone, you're talking about 1948 and 92 trillion that's going to be passing on from one generation to the next. Right. So if you look at the Chinese government's foreign reserve, which is as of last year about 3.2 trillion. So what you are looking essentially is that the Chinese government are going to pass on their whole foreign reserve from one generation to the next, which is about 20, 25, 30 years younger, and they're going to do it for the next 30 years. And along the way, this number is going to go up. So I think it really about if you're going to be part of this industry, you better understand what the next generation will be thinking and their preference is going to be.
I love it. You've basically made clear why this is the most important panel of the day. Ignore everything that went before, right? This is the thing you need to understand. So Stephanie, with that in mind, we know how big the opportunity is. What are the risks of this generational transfer?
Yes, so with opportunity always comes with risk, right? In Chinese, the word always tends to go together. So I think what Chiman mentioned, I just came back from Shanghai this weekend and everything was booming. And he rightly mentioned, I think China is the biggest market. But I think there are two things that when we think about wooing the next gen, particularly in this part of the region, we have to think clearly about as an industry. First is that I also worked in China for a few years myself. For a lot of us, we probably are working for foreign brands that are offshore, trying to tap into onshore market. Foreign brands who we thought are very well known outside of China, actually, some of our sort of onshore clients might not have heard of the likes of the biggest foreign names in the world, and they tend to sort of have this home-based bias that, oh, these are the names that I'm grown up with. So brand building as like a foreign sort of name, especially based offshore, is something that's really sort of important for us to think about. And then second is when we think about the next generation, and I also think back when I was growing up, if your parents are using a certain sort of firm or a certain set of bankers, do you necessarily want to sort of reuse the same sort of providers that your parents use? I think that's a question that we want to ask. Do the young generation really wants to sort of try something new, sort of be like, oh, I'm now sort of establishing my presence. Maybe I want to try something new, right? So thinking about how do you have multi-generational sort of offerings and teams to serve the new generation is something that's also important, because they might not necessarily want to sort of exactly use the same thing just because the family's been using the same sort of providers for the past decades.
I note that Stephanie is living what she says by wearing an Endowus t-shirt. Brand building is really, really important right now. Maybe we kind of focusing in a bit, Chiman, how do we define this generation? And I specifically want, when we talk about this next generation, how they're different, what are the overhyped differences? What are the underappreciated differences? How are they really different that some people in this audience may not understand?
Sure. One of the, when we say, wealth transference, which means, from one generation you're passing to the next, then it's about understanding how they see the world. And two arguments I always put forward is about risk and return. How do they define risk fundamentally? From one generation, for example, if you talk to the previous generation, you talk about risk, it's about, in the financial market, about 60-40, right? But the next generation, they add in more elements, which means, let's say, private equity, real estate, digital assets. So all these other, the asset class they look at is a lot wider, right? So in some sorts, you can argue that the newer generation, they have more to add to their portfolio, right? So some of it is this more volatile, there could be volatility. But if you look at it from a portfolio perspective, it's actually good for the portfolio. And the beta alpha is actually improved with the volatility, more volatility asset class. So that is on the risk side. On the return, on the previous generation, I think what they look at is financial return mostly, right? They basically, a lot of decisions are pretty much being dictated by financial returns. But the newer generation, yes, financial return is one thing, but there are also other elements they look at. For example, the social impact. So these are the returns they look at. And also fundamentally, we got to understand the new generations, especially in Asia, I think that there is really hard to define which country they're from, because generally this new generation, they are very well traveled, they are very well educated, and they were born and grew up in the internet, in the internet boom. So to them, the world is almost like a village, right? So I think how they see risk and how they see return is fundamentally very different.
Okay. As a past trader, I like the fact you define it as risk-reward return. So a tolerance for slightly higher volatility and diversity on the risk side. And on the return side, it's not just financial returns. Still most important, but not just that. Same question to you, Stephanie. How do you define this audience you're trying to capture?
So I want to expand on what Chi Kwan said. I agree with what he said, but I think one more aspect I want to add, and he kind of alluded to, because we're talking about intergenerational transfer, and I think majority of the transfer is transferring to millennials, and they're digital natives. So they were all born with sort of doing everything on the phone. So I'd also stress an aspect is they also care about the experience. And I think we always talk about digital versus offline. It's actually not so clear-cut anymore. I think the next generation of clients, I have bad news for all of us, is going to be difficult to serve. It's not just online or offline. It's going to be omni-channel. So they're going to be like, oh, I want to be able to have the news and the information on my phone. But if they have a question, they expect I call up someone. Someone should be able to answer my call. Or if I send an email or send a WhatsApp. So it's going to be harder to serve them because they're going to require omni-channel, and I think it's also presents a lot of opportunity. So Endowus, we are a digital-first platform. I think digital-first doesn't mean you eliminate the human aspect, but with technology, you can lower the servicing costs. You can do a lot of interesting things such as personalization. So in that way, I think it's to add on to what was discussed, I think the experience side is going to be also something that's interesting. How we craft the next generation's wealth experience is something that they're going to care about. It's not just about returns.
So when you say omni-channel, when it boils down to it, is that really just about being a much quicker turnaround time for response rate? So, it's true that the primary means of communication with your wealth manager in the past might have been by phone and by meetings, and then it was by emails, and now you've got social media and other ways. But is the change really that just like you now expect to be able to WhatsApp your wealth manager at any time of day and get a response instantly, or is that really the change?
So I sort of been through this myself. I moved to fintech about 7, 8 years ago. And I'd say when I first moved to fintech 1.0 is exactly what you mentioned. What we saw was just moving things from offline to online. So previously I go to a bank and then now I can do things on a mobile phone. But I think we're really at the cusp of, or we've started 2.0 and it really accelerated by COVID, is not just being able to do things online faster, but how do you really harness the technology, the data to provide sort of more in-depth sort of next generation experience through AI, through personalization. I think ChatGPT is a hot word, but I do think there's a lot of sort of imaginations of the next generational experience we can harness the technology to provide to these clients. Is not just doing things online, but providing things that they find value for through the data, through your interactions. How do you provide things that they find it's valuable? I think this is something that I find super interesting, and not just, with technology, I'm able to respond things faster.
Okay, so I have a question for both of you, and I think there's probably a mixture of people in the audience. There's people like myself who are like, maybe not at the forefront of this digital transformation, and therefore but aware it's happening. I guess I'm looking for some concrete examples of, like, we use this phrase digital transformation, this kind of trope, but like, what does it really mean? But specifically in terms of building new ways of trust and engagement, how does that work? Can you give me some concrete examples? Stephanie, I'll go to you again first, but I will ask you afterwards, Chiman.
So when I think about how do you build the next generational sort of wealth experience, I think we go back to the champions that we've seen in the tech sector. Why I really like shopping on Amazon, on Taobao, is because it's not just they moved everything online. There's so many things to buy online. But when I go on the app, they really sort of recommend me things that I find interesting and find engaging, I find useful, right? So I think for me, for Endowus, what we're trying to do is similar, provide that curation for clients using sort of our professional sort of wealth experience DNA married with technology to really curate that experience for clients. So to be more specific, our comms to client is not sort of one size fit all. We do a lot of A/B testing. We test, whether you're a morning person, whether you're evening person, whether you like numbers in your email headers, whether you like words in your email headers, what is the open rate? And these are things that we continuously monitor and see whether the clients would like sort of our comms better. And we continue to improve our engagement with them, because I'm sure all of us back a few years, our mailbox is spammed with a lot of emails, and they tend to just be one size fit all, the same email, and it's not very personalized. So that's something that we've been doing, and I'm also curious to hear more from Chi-Kwang what he's been doing there.
Please, I think there are a lot of similarity between Raffles Family Office and Endowus, but I think in terms of the technology and how much digital transformation is going to affect the segment of client that we are targeting is fundamentally there's quite a big difference, right? I think in terms of digital transformation, it play a bigger role probably in Endowus, but I think in terms of Raffles Family Office and the ultra high net worth, I think it play a much smaller role. Right. However, since 2017, 2018, one of the strategy that Raffles Family Office that try to future-proof ourselves is via the spectrum of asset class that we go into, and potentially, of course, the depth that we go into. For example, one of the things that we look at is private equity. But when we say private equity, we are not talking about a blind pool of funds. We are talking about direct investments, right? Because this future generation, they want to have the full transparency, and they want to be actively participating in the building of this company. There's going to be a financial return for them, but definitely they are also prioritizing other things like, for example, the social impact, right? So, which is definitely on a very high priority list on them. And of course, real estate, digital assets. So these are the things that I think play a much bigger role in terms of the ultra high net worth that Raffles Family Office is going after. In fact, last year we launched another family office that focused on purely digital assets. Right. Underlying is the blockchain technology. I mean, of course, when we talk about digital asset, we are not just referring to Bitcoin, Ethereum, this cryptocurrency. What we are really after is the stable coin that I think is going to the future. And right now, you have e-Hong Kong dollars. Recently, I came back from Shanghai as well. The e-RMB is really out. Bank of China is really promoting this quite actively. And of course, in Japanese smart Japanese yen, Singapore dollars, US dollars, stable coin. A lot of this stable coin, potentially they are going to be backed by central government. right? So in 5 years from now, a billionaire may turn up at our door and say, you know what, I like you, Raffles Family Office, would you like to take care of my assets? However, 30% of them might come in the form of new currency, which is a digital currency that is backed by the government. And that's when the custodian, the product and the strategy has to change, right? So that is why when that happens, that 30% will go to Revo, Digital Family Office, and the 70% will go to Raffles Family Office. And constantly that's how we future-proof ourselves.
Okay. When you say they want much more depth and on their investments, is it they actually want much more influence and control over what's happening, or is it they want the feeling of more influence and control? Which is it?
I think it's a little bit of both, really. I mean, if I have to be honest, but I would say the majority is really about, making a difference. For example, let me give you an example. Let's say real estate, which is, in Asia, an average Asian family will have about close to 30% exposure in this asset class. And when the new generation take over, right, what they want to do is, there's a new way of dealing with this, the very traditional asset class, right? So how do you turn a building from brown to green, right? And that's when you need expertise on turning the property from brown to green. And then, of course, you talk about there's a green premium, as we say, there's a better return. And of course, but ultimately, fundamentally, the second or the new generation, what they are really after, they want to have a positive social impact on the society as a whole.
Okay. And by the way, Chiman said that, Raffles Wealth Management and Dowis are more similar than I think. I'd be remiss not to observe his little pin, Raffles pin. He's also aware of branding and the importance in a more subtle way. I guess I'm curious about the gender balance shift that's happening in Asia wealth as part of this generational transfer. So particularly in the last 25 years, there are many more female entrepreneurs, many more powerful female businessmen. And it's really, really changed from 25 years ago, where the wealth was very much managed in many quite patriarchal societies. How is that affecting how you're doing business?
I think it's a very powerful force, and we definitely see that on our platform. We see sort of very balanced kind of gender split on our platform, that historically you'd imagine that maybe the male is responsible for taking care of the family sort of wealth planning. But I think we do see that female, it's really taking a much more critical role. And I think we alluded to this in our early conversations, and it is because this generation, they're more educated, they're more sort of well-traveled. And I think one word that was mentioned, and I really want to raise it again, is this word about transparency. It's because they're more educated, they really want more transparency, and I think that's why technology comes to a role to this. With technology, everything sort of, it's more clear, you provide more transparency. Historically, I think the industry, we like to bundle things together, and it's difficult to unbundle when everything it's in the stack of very thick paper. But if it's sort of digital and people want to take their finances more seriously, then they want more transparency. I think that's part of the reason why female are also taking more of a role, that with technology, with digital platforms, that you can have more access to information, more access to advice, they can take charge into this. And I think it's very interesting. And as you mentioned, right, it's not just helping with the family. We have a generation of female entrepreneurs as well that's generating a lot of wealth themselves. And I think this is something that's a very booming area. And I recently also started writing columns specific to this area, because there's just so much demand for this, that people looking for advice, for peers' advice. But it's historically, it's not a big focus area, but we do see there's a lot of interest in this area.
Okay, and just before I follow up with that, if you want to ask any question to our panelists, you've got about 3 minutes to lodge something in through the QR code. It's also on your little badge, by the way. You can see the little QR code to enter a question. I guess with that evolution then, does that mean there are many more, I'll ask this to you, Chiman, does that mean for family wealth now, are there many more stakeholders? So if you've got a very wealthy family, it used to be quite a centralized decision process. Whereas now, do you have to make your offering appeal to much more broader set of the family, even though it's only one account, or does that not? Do they just have separate accounts?
I think it's every family is different, right? I would say it's a little bit of both. But I think from my perspective, from my observation about Raffles Family Office, is that about 1/3 of our clients are actually single family office. right? And generally, they are in a range of between 5 to 8 people, family office setup. And if you really look at the amount of wealth that is being created and the kind of asset class they're trying to cover, it's really a small number. Right? So a lot of it, they outsource, let's say, part of it to a multifamily office like us. And that makes a lot of sense because in terms of cost, in terms of efficiency, it makes a lot of sense. Right? So I think in terms of, really what multifamily office, single family office, in some way, it's not really a competition. It is more of a working together. And one of the key things that I put forward as a Raffles family office also at the same time is about sometimes linking up the different families that they would add value to each other, right? And that is also one of the key reasons sometimes people use a multifamily office like us, right? Because they might potentially say, I'm very good at this market in this industry, but I'm looking to expand to the other market, in the other country in the same market, and it makes a lot of sense for someone strategically, to be introduced by a middleman, by a multifamily office like us. So when we do that, then I think there's a lot of value we really add to the family rather than just returns.
Okay. Question to you, Stephanie, and we're running out of time, but soon. Any strong interest in creating family foundation legacies? What are your thoughts around that?
I think echoing to what was mentioned earlier, there is definitely this strong sense of ESG giving back to society for the second generation. So I do think there is this increasing, and it has been there for a lot of years, but I think the second generation really wants to take a sort of more direct sort of approach in terms of how they think about philanthropy. So I think there is definitely interest in that to sort of build out the family legacy in terms of the areas of philanthropy.
And you mentioned earlier about transparency. Is that squeezing fees too much, or is the next generation aware there needs to be fees? They need to pay for a service, and as long as it's transparent, they don't mind paying the fee, or what's the situation?
It's interesting. So my firm's model is all about sort of transparency and fees. And I think you rightly mentioned, I think people are, if you give them good advice, professional advice, they know they're willing to pay. But I think the next generation, they're more educated and they just want to know, so exactly what are the fees, how are they justified, what kind of value I'm getting out from the fees. So I do agree that if you can sort of provide more transparency, people are willing to pay. But I think why people are a bit hesitant and about sort of old fee structures and are sort of interested to learn more sort of our fee-only independent fee structure is that they want more transparency. They really want to understand what exactly am I getting out from your service.
Okay, we're running out of time, so I'm going to conveniently skip the question which you did get. With the rise of digital players, what are the factors the next generation consider when picking their own provider? Okay, go on. 10 seconds. What do you think? Obviously, you both think your own firm, which is why I was going to skip.
Well,
give me a 10
I think for this, I'm going to say, Revolt Digital Family Office, the foundation of it is based on regulation and governance. And I think if there's one thing that you need to look at, is definitely regulation and governance. And this is exactly the foundation of Revolt Digital Family Office.
Okay. And Stephanie?
Same, transparency, cost, fiduciary duty, sort of be agile, provide something.
Isn't it regulations?
So basically you're agreeing, you're the two best firms. These are your only two options for the next generation wealth management. That's the end of the session. Thank you very much. Please enjoy the rest of your day. Cheers.
So thank you. Thank you.
Please welcome to the stage Nicholas Chow, Chairman of Asia Worldwide Head and Chairman of Chinese Works of Art at Sotheby's, for a conversation with Bloomberg's K1 Ha.
All right, thank you for sticking with us to the last conversation here, and I promise it's going to be really interesting because I've spoken to Nick before and he's a lot of fun. Nick, I wonder if we can set the stage a little bit, set the scene. What are we seeing in terms of demand for artwork here in Asia? Who's buying?
Actually, at this moment, globally, Asian art buyers are really powering the market. So whether it's in luxury or global fine art, there's about 36% of our turnover globally is Asian buyers. And you'll see them active, obviously, in the areas where they expect to be, Asian art, luxury, impressionism, contemporary art. But even at the very top end, in, let's say, old master paintings, you'll have top transactions. I mean, when it was about a year ago, we sold a very important Botticelli for about 80-some million, and the underbidder was from mainland China. And so you'll see them active throughout the whole spectrum what we offer. In luxury, of course, they really weigh quite a lot, 40-some%. And in cutting-edge contemporary art, Asian buyers today are really sort of buying voraciously. So over 50% of our bidding comes in the now sell. The now sell is a sale of contemporary art presenting really cutting edge, is powered by Asian buyers.
Oh, that's really interesting. I mean, obviously, the last couple of years have been quite traumatic, right, for all of us. I mean, we obviously throughout the pandemic, I mean, we all felt the economic impact of the global pandemic, and China's market was hit especially in terms of the economy there. What did we see in terms of the slowdown's impact on art collecting there in China and the rebound that we're seeing now?
Well, during the pandemic, actually, if you look at 2021 and 2022, these were our record years for Sotheby's here in Asia. So it's really sort of bucked the trend, particularly with the strength of contemporary and modern art and luxury. And now taking the backseat of the pandemic, we had Chinese art, because Chinese art really sort of relies on all areas that are very connoisseurship driven, where you need sort of first-hand inspection. For example, with paintings or porcelain, where you've got issues of condition, quality, sometimes debates around authenticity. People want to engage with that material. So in those areas, it was very hard to tease sellers into consigning their best property. But what we saw last month, which was our all-important sort of 50th-year anniversary for Sotheby's Asia, what we saw was a return of Chinese art buyers and a return of Chinese art. And in fact, it was a sort of 9-year record for all the traditional categories. It was quite extraordinary. And the top 2 prizes this season, we had on the one hand, a painting by Zhang Natian, which is a beautiful gold screen splashed with lotuses, painted in 1973, the very year when we came to Asia. So it was an important sort of symbolically, this piece sold for about $30-some million US. So close to a record, not quite a record for the artist, but one of the top prices. The second highest price, again, a month ago was for Chinese art, this time imperial porcelain bowl that dated back to the 18th century. That was bought for over $25 million by a mainland Chinese client. We saw, I think, 3 times as many Chinese buyers as we saw in the last 3 years active in our sales. So that really spoke to the strength of the rebound of the Chinese art market.
Yeah. Is that robust?
That's very robust. That was over $200 million in sales of Chinese art. That's as good as anything.
That's great. I mean, obviously, the demographics of who's collecting in this region has also changed, right? I mean, Asia is home to the second largest art market after the US. Tell us a little bit more about that shift in terms of who we are seeing, who's buying, where are they from? A lot of millennials,
right?
Chinese, but otherwise.
Right. I mean, around the region is quite balanced. We have buyers active from all across the region. Obviously, in terms of numbers, most of the pieces we're selling together today are actually flowing back to China, whether it's in the field of luxury, Asian art. For contemporary art, actually, it's quite balanced around the region. Taiwan, I mean, it's not sort of, it doesn't fit the narrative that people like to follow, but Taiwan continues to be extremely solid. We have very sophisticated buyers in Taiwan that have been active for decades and that are still sort of powering the market in the region. Koreans have been very strong. You've had, of course, with the Fes Free Soul opening up last year, more and more interest and the market being very vibrant in Korea. Southeast Asia is very strong. Singapore, we've had our first sale last year in 15 years in Singapore to try and bring back the art locally and making a sort of slightly tailored sell for Southeast Asian buyers with a sort of 70% composition of Southeast Asian art. That is also to capture what is happening in Singapore with the great sort of migration of wealth there. And also as an outpost to develop the Vietnamese market. We've done quite a lot in Vietnam as well because in the last, let's say, 4 or 5 years, Vietnamese buyers have been an incredible new power in the scene.
That's interesting.
Buying, of course, their own heritage,
yes.
Vietnamese artists, but also expanding to Asian modern contemporary art, Chinese art, and many other areas.
A lot of new aspirational wealth there in Vietnam.
Absolutely, yeah.
And also just the demographics here in Asia of who's buying is very different. That's shifted quite a bit as well, right?
It's shifted a lot, and I think with the pandemic and our sort of refocus on digital tools, I mean, innovation and technology has always been, at the forefront of what Sotheby's has been doing. And actually, at the turn when the pandemic hit, we were already ready, and we shifted immediately into a sort of a hybrid model, which is online sales, but with a sort of physical. You have an auctioneer, multi-screens, and sort of brought the excitement of the physical auction to the screen.
Yeah, and that's I imagine that's also bringing in a different kind of buyer,
exactly.
Younger.
Yeah, brought in a totally new demographic.
Yeah.
People can we had millions, every time we have an evening sale, a marquee sale, you have millions of viewers across all our platforms. And that also, during the pandemic, we also moved into more online sales at different price points. And we saw now actually this last year, we had 91% of our bids came online. So people are really used to and enjoying the online platform bidding, from the comfort of their homes. And what we expect usually is the engagement to be at the lower end on our online platforms. But actually we had 2 years ago a bid for a Francis Bacon triptych coming online at $70-some million US. So that was extraordinary.
Someone in their slippers bidding, let me put 70 million there.
Came from, actually, was Justin Sun, which is a sort of crypto tycoon, I think, many of you will be familiar with.
Fantastic.
So, you see millennials have been very strong. 30% of our buyers today are millennials. And this is a trend we'll continue to see.
That's great.
Even Gen Z, actually, now in our contemporary day sales, are an important force.
That's fantastic. We're going to bring up a photo of a Chinese cup there. This is the so-called chicken cup.
Right.
Yeah, tell us more about the chicken cup.
Right. So actually, the picture on the right really made the rounds of the newspapers about 9 years ago. And when we saw this is a cup that dates back to the Ming Dynasty, the third quarter of the 15th century, one of the most fabled objects in the history of Chinese art, and certainly the most copied. If you go to China, there are tens of thousands, possibly more, fakes of it. And so when we offered it, and actually this is just a little bit of a glimpse into the world of Chinese collectors. The person you see on the screen is Liu Yiqian, who is with his wife. They're heading the Long Museum in Shanghai. They're among the most sort of forward-thinking, the greatest force among collectors in China. They've composed one of the greatest collections, harking back to early Chinese art, early Chinese bronzes, all the way to all the sort of the fine imperial arts of the Ming and Qing dynasty, to revolutionary paintings. They have the greatest collection of revolutionary paintings, to Modigliani's, Richter's, and cutting edge, feminist contemporary art. So the whole gamut.
And of course, the story behind him is he was a former taxi driver.
He was a former taxi driver.
Became a tech or became a stock trader who now, of course, is one of the biggest art collectors in the world.
One of the greatest art collectors in the world, has bid on some of the most famous paintings. And here, he came to buy this. There's a lot of this sense of there's a great sense of patriotism in a way our Chinese collectors have been buying over the last 20-some years, buying back, great cultural artifacts. And so when he came to pay for it, that piece made about $38 million US. He came with his Amex card, so swiping it back and forth. And after paying for it, he said, hey, can I see it? So took him to a space, he took it out, he examined it in the palm of his hand, enjoyed it, and immediately said, hey, can I drink from it? I said, hey, you can do whatever you want. You just, he just bought it, poured him a cup of tea, and drank from it. And so the picture circulated on the social platforms
Totally
and
went
newspapers went around the world. Then, of course, people are prejudiced against some of the Chinese wealthy buyers. And of course, there were some negative comments talking about how can someone do something so outrageous.
Because they thought it was so...
Yeah, they thought it was so low. How can you, drink from it? But what's interesting, actually, the first time we got this piece on consignment was in 1999. At the time, it came from a great Japanese collector called Goro Sakamoto. And when we picked it up, everyone was invited, for this very solemn moment to drink sake from this cup. And so when I tell people about this moment, everyone thinks there's such a, elevated, beautiful moment. In fact, it's very much the same action, drinking from this cup, but, I think it's very unfair bias against
Do you think there's kind of a little bit of a double standard when it comes to Chinese art collectors and maybe...
To some extent. Now people actually, I have to say, people enjoy all this sort of, the very direct and passionate way of collecting.
Yeah. Now, obviously, the chicken cup here was a record sale at that time. Where are we now in terms of sales? I mean, obviously, post-pandemic and everything. What are we seeing in terms of the sweet spot as well as kind of the high end there?
Right. Actually, in the last 2021 and 2022 have been record years for Sotheby's in Asia. No one's ever surpassed the totals we made, which was over 1.1 billion, 1.1 something US dollars last year and the year before. Now we're on track with our spring season 2023 to follow up on that. So these have been very, very strong years. Obviously, year to year, you see the balance between the departments and the totals shifting a little bit. But I would think that the performance, we've managed somehow to sustain it.
Yeah. Are we seeing kind of a softening at the very high end?
Actually, the very high end, we have certain prices. Now, of course, for some of our Chinese buyers, it's not so easy to move funds across borders. So you've seen maybe at the very top end, slight softening, but there's a sweet spot between 500,000 US and 5 million US, where the market is extremely deep and where we make many transactions. From 10 million US and above, it's, firstly, it's not always easy to find great fresh material. And yeah, there's a bit of a softening, but the totals remain extremely strong.
It's interesting. Now, obviously, our taxi driver turned billionaire there. I mean, he's a great example of this new type of eclectic collector, right? Who really bucks the trends, the conventions of traditional collecting. And as we were talking before, you're saying we're seeing more and more of these so-called eclectic collectors.
Yeah. Yes, I think cross-category buying is one of the great trends of the market these days. I think if you look at buys throughout the 20th century, and of course you've always had cross-category buys. I mean, in Asia, pioneers include people like Joseph Lau, who was collecting as a 20-some-year-old. In the 80s, Chinese art and very quickly expanded into other areas, Impressionist modern art. Pierre Chen in Taiwan, who was at the forefront and still is at the forefront buying contemporary art, but started with modern art, Chinese art, and sort of had an extraordinary vision for his collecting. But most collectors, it's true, throughout the 20th century, have really focused on narrow areas, you could say quite geeky areas in collecting, and stuck to it their entire lives. Blue and white porcelain, coins, just even certain artists in modern art. And now you see a widening of the interest. I think people's, with social media, etc., people's attention span is sort of, lowering, and people like to be stimulated with, all sorts of
lots of
new areas. Exactly.
That's great. We're so tell us more about this photo. You see it?
Right. Oh, actually,
These two,
so this is a cell we had 10 years ago in 2014, 9 years ago, and which really sort of captured or announced the zeitgeist we're still in, which is a convergence between art, fashion, music, and all these worlds. People nowadays, I think, like to enter a portal like this, which offers multiple sort of facets into, contemporary living. And so this cell, which was the cell of Nigo's collection. Nigo is the founder of Bathing Ape. He's a sort of, fashion kind of guru.
Hip hop DJ, all around cool guy.
Yeah, Pharrell Williams' best friend has sort of really trained him, who's now taken on LV, and he's now at Kenzo. And so this collection which mixed in fashion, jewelry, luxury, art. I mean, you'll see the cause here is the first time most people actually were ever exposed to it, and really that cause really took off. That was 2014, thanks to this collection. You had all these elements that made for an extraordinary cocktail that really brought in a record number of new clients. And these are the sort of experiences and the direction of the market today, which is really mixing it in. And when you mix things in, what's extraordinary is it's impossible to predict who the next buyer will be. And in this case here, we just juxtapose this picture of Robert Chang, who is the person who bought that Jacob & Co. dollar necklace. I mean, when we had this piece in the cell, we thought, and we saw Jay-Z and other people from other friends of Nigo posting it, and we thought it was going to end up with some rap star somewhere. But actually, it was a 86-year-old collector of Chinese art. Yeah, with a taste for bling, for sure. He's been,
very hip. Very hip 86-year-old.
I've seen pictures. He's been wearing sunglasses since he's 12 years old. So there is, this is the beauty of the auction world, is the unpredictability, is that the mysterious ways that objects and people converge, right? And people take that adventure with an object.
And you're probably seeing that more and more with hybrid. I mean, with the auction going online, right? Is that anybody from anywhere? Yes,
exactly. Everyone's exposed to everything that we sell, and of course, the way we position things through curated sales. Of course, on the back of this sale, we've done multiple collaborations with other personalities, often from the world of music. We've done. My colleague Yuki Terase used to run the contemporary department, did 2 other collaborations, one with Top, the South Korean music artist, another one with Jay Chou a couple of years ago, which were incredibly successful. People just get to experience these objects in different ways, right? You have the same thing, but if you combine it in different ways, it actually really becomes something else.
Yeah.
The combination of items you put together will cut windows in each other, and you'll see them differently.
Really stretches kind of our perceptions of what is art.
Exactly.
Collectability.
Yeah.
We've got some really good examples of that too, which I think speaks to the young eclectic collector. Can we bring up the next photos of the curiosities? There we go.
Right.
What in the world are we looking at?
So this is another model of sales we introduced 10 years ago, which we ran all the way until the pandemic. We stopped because these items are hard to source locally, impossible to source locally. These were sales of that presented themselves as a contemporary cabinet of curiosities with objects of natural history, old master drawings, African sculpture, Roman art, Egyptian art, contemporary art, mixing it all in. It was a way to introduce our clients here in Asia to all sorts of new areas, and testing the market and seeing what people respond to. Also, taking objects out of their context makes the experience of them much lighter, right?
Yeah.
What we've done before is, for example, when we try and introduce people to old master paintings, you'll bring a whole exhibition to Asia, hang a number of paintings, 20 paintings, and you have Western colleagues standing there with their attaché cases. It's kind of feels quite threatening for a lot of buyers. Now here you take them out of their context. It allows a very easy experience, purely aesthetic, and yeah.
Where you don't have to be like a serious buyer who really understands this or really knows the academics behind it. Or
you can take the journey first and really actually do the work afterwards. So this is one of the directions of the market, and certainly something that we'll continue doing in this part of the world. Because actually in Asia, right, the market is sophisticated to some extent, but if you want to buy Asian art from the ancient past till today, you'll find many sort of, access points. If you want to buy modern contemporary art from Asia or elsewhere, you'll find many places to buy it. International galleries, art fairs, auction houses. If you want to buy something outside these areas, there's nowhere to go. If you're interested in old master paintings, French furniture, African art, even 20th century design. So there's a lot of room to educate and expose our clients, and Sotheby's sees itself as a gateway for that.
That's great. We have about 5 minutes left. We'd love to take any questions you have, so please type them in there using the QR code. Actually, here we've got one now. How much art investing is by PE funds? What type of art, and what are their investment objectives and strategies? Is that something you can talk about?
Actually, yeah, we do have certain funds buying in our sales. You have investment funds, and often actually they spread their interest across areas, right? So they won't be confined to necessarily digital art, modern or contemporary. They might sort of spread their assets across areas.
Are we seeing more and more purchases by private equity funds?
I mean, you'll see sort of, investment funds coming in when the market is particularly frothy. So for example, in 2010 and 11, you had so many investment funds. That's the only thing people are talking about, investment funds in art, right? And at this moment, they're still active, but it's not the main trend. They're not. Most of our buyers are still private collectors. For the most part.
I mean, art traditionally has tracked with how the global economy is doing. Are you feeling that this is where we are now? Is there really strong correlation? I mean, obviously you've got a upcoming sale, and how are we?
At this moment, I feel if you look at our sales, our April sales that just closed a month ago, actually, where the auction market is still very resilient and very, very strong. It'll be interesting, actually, in a couple of weeks, we have our New York sales, in our May sales, which are real sort of bellwether for the art market in general, where all the greatest contemporary and modern international art is being sold. So market observers will be tracking those results very closely.
Great. We've got another question here. How are NFTs and digital innovations disrupting the art industry?
I mean, when NFTs really stormed into the market 2 years ago, it was an incredible opportunity for us to really engage with artists and curators. And but obviously in the last year and a half, there's been a slight correction to the market. Now we have our platform, our Sotheby's Metaverse platform that we've launched last year, which will be trading both primary and secondary art markets of digital collectibles. Actually, we're ready for the market when it picks up again. If that's anything to go by, actually, the Art Basel last month, actually, the top transaction was an NFT. It was a sculpture by Beeple, and that's, I think it sold for about $7 or $8 million US. So that's a clear marker that they're coming back into the marketplace.
It's interesting. I mean, when you talk about NFTs, online and all of these, it all really speaks to making art just a little bit more, less threatening to people, and in some ways making it a little bit more accessible to.
It's very accessible, and for people, particularly in the contemporary arts fair, it makes it more tradable. It's so easy, frictionless. You don't have to store it. You can trade it anytime. It was, people moved into that space very quickly, and from all areas of business. Actually, one of our very best friends is was a collector of Italian Renaissance drawings, and within a shot sort of moved on into the NFT space. So anyone can be your next NFT buyer. It's extremely sort of, easy to keep and trade.
Great. Can we show the last photo there? This
Right. So this will be our headquarters. Actually our showroom from next year in the Nexus of Central. So this will be
right
the
smack on the street, storefront.
street
Anybody
level,
can walk in.
one of the greatest facades in Hong Kong, and it's a very exciting move for us. It'll be the biggest change we've seen in Asia for Sotheby's since we came here 50 years ago. So we'll bring art and luxury to the doorstep of our buyers, make it more accessible, make it exciting, and you'll come into this space where you'll be exposed to art from prehistory to the present. It'll be incredible.
And will prices be something that I can actually pull out my credit card without maxing it?
Actually, people have preconceived ideas about our entry points. Actually, if you look at our online sales, there's a lot of relatively affordable material starting from 5,000 US and above, the whole range, and we'll be offering that all year round through our new Buy Now channel in Cheddar House.
Great. Well, I'm looking forward to the new storefront next year.
Thank you, Anne.
Thank you so much, Nicholas.
Thank you.
Thank you.
Please welcome back to the stage Bloomberg's Mark Cudmore.
You're a very polite audience. Can't believe how many of you are still here. Very impressive, very, very keen. That's because the panels, I think, were absolutely brilliant. I love that last chat with Nicholas Chow there on the art as an investment in this new modern world. Really, really a fantastic day. We are out of time. I'm obliged to say that the conversation continues on social media. So it's at Bloomberg Live on Twitter and LinkedIn. And if you search for hashtag Bloomberg Wealth Asia, there are ongoing conversations there. I'd also like to take a moment to thank our sponsors, who you can see on either side of the screen there. So our founding sponsor, HSBC. Thank you. Give a round of applause if you want, or not. Our supporting sponsor, Royal Bank of Canada. Boom. There's only one more to go, don't worry. And then, of course, our participating sponsor, Invest Hong Kong. Awesome. I've got the hang of this. Thank you very much, everyone. Also, thank you to all the panels. I thought the panels were really, really interesting. And it's a testament to how good they are that after a long day, actually, many people are still here at the very end in kind of, you can tell everyone's actually looking at the screen. 90% of people aren't looking at their phones, which I find is amazing in this modern day world. So that is brilliant. Please do keep track of other events we do in the future. I think our next one is Bloomberg Invest New York, coming up on June 7th and June 8th. But check our website, bloomberglive.com, to get details of future events. Otherwise, I'm Mark Cudmore. Thank you from all of us at Bloomberg for a great day. Enjoy the rest of your day. Thank you very much. Goodbye.